Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the podcast, my guest is Robert Bendetti. Robert is the CFO of Life Cycle Engineering, and he's held the CFO role in a number of organizations. He's an accountant, he has an MBA, he has a master's in accounting, and a wealth of experience when it comes to executive financial management for small and mid-sized organizations. He joins us today to talk about his thoughts on proper cash management in small businesses, what we all need to be thinking about in terms of cash cycle, cash conversion, creditworthiness of our customers. We also talk about his thoughts on M&A activity, mergers and acquisitions, what you really need to be thinking about 18 months before you're thinking about exiting from a company if you're approaching your own retirement or transition, and his thoughts on employee stock ownership programs. ESOPs, or employee stock ownership programs, are a topic that I've been wanting to cover on the podcast for some time. And coincidentally, Lifecycle Engineering is an ESOP business where a portion of it is owned by the employees. So Robert shares a lot of his expertise on our show today. He shares his thoughts on when an ESOP is and is not a good fit for a business transition, and the good, the bad, and the ugly of employee stock ownership programs in general. I hope you enjoy it. Hey, everybody. Real quick before we jump into today's episode, I have been advised by my attorneys to remind you all that none of what you might hear in today or any other episode of Grow Money Business is financial, investing, tax, legal, fitness, or even relationship advice. It's content that you're free to use and deploy on your own terms. And before you take any actions on what we might cover in the show, I really encourage you to consult with your accountant, attorney, or financial planner. If you don't have a financial planner and think that you might need one, be sure to check out threeoakswealth.com to learn more about my firm's planning, advice, and investment services. Robert Bendetti, welcome to the podcast. Thanks for joining me today.
Thanks for having me, Grant.
So, Robert, you are the CFO of an engineering firm. You have a lot of financial CFO accounting experience in your background, and I'm really happy to talk about cash flow and mergers and acquisitions and ESOPs if we have time on our call today. So I appreciate someone with your experience joining us. We are in the middle of corporate tax season too. Does that have any impact on you in your role as CFO? Is it busy for you right now?
Luckily, I hire somebody to handle that. So it's crazy for them and not crazy for me.
That's good. That is a pro move right there. Delegate so you don't have to deal with it yourself. So tell us a little bit about your role in the engineering firm and your background.
Sure. I'm Robert Bendetti, like you said, CFO at Lifecycle Engineering. Our specific niche is reliability engineering. So I like to say we don't make anything, we just make things more reliable. We do that for the Department of Defense, supporting the warfighter, and also manufacturing. So if you have an asset and you need that thing to run, we'll help it make it run reliably through operational excellence. So, and even engineers need bean counters like myself. And so I'm the CFO there, get to work with a great team, love my job, love the team. And I'm true accountant. I didn't come from operations. My undergrad's in finance. I have an MBA with a concentration in small business management and entrepreneurship, master's degree in accounting and financial management, and I'm a certified public accountant.
Right on. I like how you hedge that, because sometimes accountants are reluctant to say that they're accountants because of the stereotypes and negative connotations. I like how you phrase that.
Oh, I am super proud. Usually I put my hands on my hip and kind of give a little Superman stand like this and say, when people ask what I do, I say, I am an accountant.
Well put. And that sets you apart from most of the other accountants out there, I would imagine. So let's talk about cash flow management in small businesses. Most of our listeners here run small businesses with, I would say, fewer than 25 employees. And a lot of people that we run into at the financial planning firm really don't have any protocols or framework around how they're handling cash in their business. You have revenue that comes in at the top of your P&L. You have some expenses, then you have this money left over. nobody's really sure how to arrange that to foster growth. Nobody's really sure when and how they should be paying themselves and taking distributions. How do you think about this as a CFO?
Well, I'm going to bridge that conversation, give you some ideas over that spectrum. I'm going to pitch you some stuff, Grant, and you give me some feedback. All right, here I'm
Okay.
going to pitch you, talk some cash flow, what to do with cash flow if there's anything left over, and give you a spectrum of choices. And you can tell me if you like my ideas or you think my ideas are crazy.
I will do that.
So one, I think you started it off really well because you talked about revenue, profit, and cash. And those are totally, totally different things. Revenue is vanity, profit is sanity, and cash is reality. And most people, small business owners, they think of revenue, that's everything. They're busy. And so their business must be doing okay. And that totally isn't true. And the only thing that really matters is cash, because the only thing you can make payroll with is cash. And I think cash flow management is absolutely critical. It's a personal passion of mine. It's something that I'm really good at, and it's helped me advance in my career because it is really important for small and mid-sized businesses. And if you do it wrong, the outcome could be going out of business or going bankrupt or just really expensive. It can just be really expensive to get this wrong. So I frame that up that I do have a passion and it is important. And for the audience, why would they care? Is the days of fast, cheap, easy money is over. So it does really matter. If you've only been in business for 5 or 7 years, you may never have lived in or done business in a raising rate environment while there's inflation. And so both of those are going to occur, inflation and rising interest rates. So the first thing I think somebody should do in this cash flow management, if I give you a quick, easy checklist and talk at it like a business owner level, not accountant. First step is just reviewing your customer and job selection, both confirming that your jobs that you're accepting are profitable if everything goes right, and that the credit worthiness of those customers. That's something not all businesses do. They're just really happy to get busy, or they've never been burned because the past 5 years have been pretty good. Even with COVID, everybody was liquid with cash. Everybody's paying on time. Personal bankruptcies are historic lows. Corporate bankruptcies are historic lows. Everybody's gotten used to paying everyone. That isn't real life. In real life, people pay slow, pay no. And so number one is this is the time for a quick review of your project profitability, your customer profitability, and then getting back in the habit of checking the credit of people that you're giving trade credit to, because not everybody is worthy. Number two
That's true.
is...
Can I interrupt you just for a quick moment?
Give it to me.
Most of our listeners are owners of smaller businesses. While we do have some manufacturing and widget makers, physical product kind of businesses out there, I would say most of them are in professional services. A fair amount of them are in, your accounting, law, and medical professions. Particularly the medical professions are getting cash, or they're getting revenue in the door being paid by insurance companies with very, very high credit worthiness in general. So just to give you a frame of who we're speaking to, I don't know that credit worthiness is that big of an issue for a lot of our listeners, because either A, they have a whole bunch of clients paying them smaller dollar amounts, or their larger people giving them money do have a lot of credit worthiness.
Fantastic. Next idea would then be, I think one of the easiest ways to improve the speed in which you are getting cash, it's called your cash conversion cycle. And one of the quickest ways to improve that is just submitting your billing, your invoicing, either your milestone invoicing or completion upon some procedure at a medical establishment. Invoicing faster is I'm no longer surprised that the invoicing process at most companies takes 2 or 3 times as long as the owner thinks it does. They think it's happening immediately, and it isn't. There's somebody's waiting on a document, they're waiting on an approval, they're waiting on a code, they're waiting on some response, and with flexible time and people slow response, invoice, you might think they go out every hour, they go out, it takes a day. If you think it takes a day, it takes 2 or 3 days, it takes a week. I think that's the first, is you can't get paid until somebody gets invoiced. And it is worth reviewing how quickly the invoices are going out. Number 2 is And I'd say this is very true in every CFO I know that works at a medical practice, is that there's usually a collections issue, not maybe from the insurance portion, but the portion that the insurance company isn't going to pay, that is due by the participant or due by the client, if you will. Collections. It's an oldie. It's something a lot of people don't like to do. They're too busy to do collections, or they feel uncomfortable doing collections. It's absolutely critical. The squeaky wheel gets the grease. If you make the phone call, you send the invoice again, you send a statement, you're going to be the first person that get paid. So it's like the most obvious thing, but there are a lot of entrepreneurs who they just don't actively enough pursue what is due to them. And then I think you also, entrepreneurs out there, there's a few, and this only applies to a few, but there's a few people who are still making the payment process difficult. And you need to eliminate all friction within the payment process. You need to accept all form of payments. You need to make it so easy, it's almost hard not to get paid. And so if you are getting complaints, oh, I wish you took this form of payment, or I wish that, do you accept this or that card, or can I pay by phone? The answer just needs to be yes. Yes, you will take anyone's money by any means necessary.
So what's a good barometer for turnaround time on an invoice? If you think that it's taking a day to get the invoices out the door, in reality it's 2 or 3. Ideally, the invoices would go out the door immediately in all circumstances. That's probably unrealistic. What should people be shooting for? Just to review it and try to shorten the turnaround time?
Well, I think so. Let's start, Grant. I think you bring up a really good point, which the goal actually is based on a predetermined milestone or activity, and it could be the completion of a job or it could be partial completion. Whenever that happens, without anyone touching it, the system should automatically generate either an invoice or a processing of payment. Because maybe you have a predetermined agreement in hand that you can submit a request for payment, or you can draw on payment immediately. So that actually is the goal. I don't want to skip over that. Now, that may seem unrealistic to some people, but that actually is the goal. Without you doing anything, you get paid. No extra steps, because you've already come to agreement on the terms and the mode of payment. And when those things happen, the system automatically makes you get paid. Reality is that there may be some friction in the process. You don't have that agreement, or there's some sort of manual steps in place. You need to try to eliminate all of those things by process improvements and by technology. Gotcha. What is possible within your industry is very industry specific and your budget specific. And so an easy thing could be, whatever you're currently doing, try to improve that by half this year. And then once you get there, you need to benchmark yourself against, okay, well, I was taking 3 days and now I'm doing it in a day. All right, that's cool. Well, then now you need to start asking peers in your industry what they're doing. And whatever the number is, the best person said, you need to try to beat that.
Sure. Okay. So we want to reduce the time it takes to turn around invoices. We want to review our client base, make sure that we're focusing on creditworthiness, and that we're focusing on collections after the fact. What's an easy way to improve your collections rate? Is it just a function of spending a little time and focus on it?
Yeah, it's before you set up the job and you agree to do the job, confirming that they have the ability to pay. Some people just get really excited because they're slow and they took some work, and not all work is profitable. So you need to make sure that this work, this project, this task, this procedure you've agreed to is actually profitable for your organization. That's first step. And then have a payment agreement developed ahead of time. Sometimes it can be as simple as, if you're all on paper, sending a form so you have all the information necessary to bill that person, or it could be automated online to load you in our system. We'd love to have you as a customer. We just need you to load your information into our portal. And then they will provide the contact information for them, their boss, emails, cell phones, and the system that you use. Very often the accounting system that you use has automated tools. It will just automatically generate based on milestones that you determine, either emails or phone calls or texts to those customers so that they pay you. And then it's just a matter of, probably is a good idea. I should be sending statements. to make sure my customers have all the invoices in queue, and people just forget to do that. Or, people, there's a lot of turnover right now, and you might assume that the big company that you're sending these invoices, some email address to, that person still works there. They don't. They left 4 weeks ago. None of your emails have been received. None of your invoices are in queue. And if, I work at a bigger company, I am not paying an invoice until I receive it. And then I've got to validate it. Well, you've been sending it to Julie. Julie left 8 weeks ago. That's not my fault. That's your fault. So how do you determine those things? You follow up, you call, you use different modes of communication to do that. How did you get that information? Is because you had a form either on paper or online where you received this contact information.
Sure.
It seems like common sense, but I'll tell you, having worked for a lot of small and mid-sized firms, and I talk to a lot more accountants than you do, a lot of companies just don't do this. Especially under 20 people, they're like, I'm really busy serving the client, serving the customer. I don't have time for this. Well, then you're just not going to get paid.
Yeah, that's very true, and it's very logical. Seems like common sense, but you don't run into collections issues when you're first getting a business off the ground. And I mean, it's a learn as you go kind of thing for a lot of people, I sense.
And then we kind of glossed over something, but I started with this, and I want to, this little piece, this segment of our talk I want to close with, is that this all assumed that cash is important, but the end result, cash you received, needs to be more than the cost that you spent, so that there is some sort of profit. And so you need to determine that before the project starts. And if it's been a long time since you've looked over the basket of your customers, and maybe you've had some clients for a very long time, or maybe you have one customer that's really large that you agreed to some sort of cost structure and pricing structure a long time ago, it may be worth a new set of eyes, a re-look. Is that customer still profitable? And what I've found out, there's this rule, Pareto's rule or Pareto analysis, is that 20% of your customers are driving 80% of your revenue and of your profit. 20% of your customers, and then there's also sometimes 20% of customers are causing 80% of your problems. But I think you need to know which one of those customers are. There might be one SKU, two SKUs, 20% of your SKUs, 20% of your products, 20% of your salespeople are driving 80% of all the good things. And you need to know which SKUs, which customers, which salespeople those are, so you can reward those. You also need to know, gosh, that means that like 80% of my SKUs or my customers or my projects or my salespeople aren't bringing a whole lot to the table. Yeah, that's true. That's true everywhere. And you just need to know that. Be aware of it.
Do you run into that a lot talking to other accountants? Is it common that a fair percentage of revenues is actually unprofitable revenue?
Oh, absolutely. Oh my gosh, that is, if they're looking at it, absolutely true. I've never worked anywhere. I've never looked at any data set where that wasn't true, that there wasn't a wildly skewed concentration of customers or product or SKUs that drove the vast majority of the contribution margin or profit to an organization or a division. That's absolutely true. There's only a handful of things I think are absolutely true, and that is one of them. You might not know it. You might not know. You might think all of my customers, all of my SKUs, all of my projects. No, they're really not.
I don't have as much direct experience with this as you, but in financial advisory practices, that 80-20 rule absolutely becomes true over and over and over and over again, like you say. It's interesting hearing context from other industries too. So
what happens usually, just to share, I'll give an example for the framework of someone. Oh gosh, if you're listening, well, that's not me, or where could it be me? I'll give you two easy ideas. One, if you have a really, really large customer, that customer probably knows it. They have purchasing power, and you're doing that. You're probably doing that work for break even. It's just your largest customer is probably one of the problems. All right, and so that'd be a good one to look at. Other thing would be is if you've had a customer for a really long time, and maybe you even value, you talk about how we don't have a lot of turnover. Our biggest customer's been with us for since the inception of our organization. They're also probably one of the problems. So those are a couple of targets to review. They might be two of the problem ones.
So let's transition this then and work down the income statement. We've talked about cash and ways to buffer cash, which is the lifeblood of any organization. How do you turn that into profitability? What other balance sheet and income statement stuff do we need to keep our eyes on?
Well, I think a way to answer that is I think you got to do something then with the cash and to redeploy that cash so that it isn't stagnant, but you're reinvesting it into value added activities to grow the business, because that's what we're here for. It's not one answer could be, okay, you're going to then invest some of that free cash flow in an investment account. That just seems really unlikely for a small business, and so I think it's reinvesting into the organization. You put those chips back into the table and double up on those profitable projects. And I think in 4 key areas. So if you've done what we are talking about, Grant and I, about cash flow management, and you now have more cash faster, then you got to do something with it. The first thing I think you need to do is maybe make some investments in technology. That there are things that are happening in your organization that are super inefficient. You can make them more efficient with technology, or there are things not happening that you wish they would. Those things can be solved with technology. I think that's the first place to look. Or maybe equipment is a more broad way to think of it: technology or equipment. Then the second is that you might have the right technology and equipment, but your people are not trained to use that technology or equipment. Or maybe the new people are not. The people you had a year ago they're all gone because of the Great Resignation. And so now you need to train. I think technology training. I think you also need to use that cash to invest in sales and marketing. I don't know about you, Grant, but in my organizations that I support and with my friends in the industry, it seems like you've got to spend twice as much as you did before to get half the results. That it's so much harder to pierce through the noise, but you still got to be making those investments in sales and marketing. And then I think for the small and the solo entrepreneur to the small business owner with less than 20 people, that you need to start thinking about delegating non-value added tasks to fractional or virtual support. You don't need to hire a CFO. You don't need to hire a director of human resources or marketing or whatever. You hire fractional virtual people to support you on a project basis, experts that are super efficient. Yeah, they're expensive, but they're also doing something in an hour instead of 2 days. And that's how you I think some 4 easy way to sort of leverage that balance sheet. Don't keep that cash just sitting in your checking account. Deploy it into your company.
How do you know whether to deploy extra cash into those 4 areas to drive profitability and future growth, or pay yourself? How do you divide? How do you draw that line?
Well, if you find that your business is in the cash cow phase, where without a bunch of effort or money you're not willing to put in it, all it's going to do is just yield a certain amount of profit, and you're older or the industry's declining, and if you're in kind of a status quo situation, and you're just like, I got 5 or 10 years, I just don't have the hustle, or I don't really care, then you just pay yourself more. And whatever is the most tax efficient way for you to do it, talking to your advisors. If you have the opportunity to grow, you're like, oof, I could yield 10, 20, 50% top line growth and 100, 200, 300% bottom line growth by making some small investments. Don't take the money out and pay yourself and buy a car or some jewelry, or invest it in your business. Much higher returns by growing your business. So you have to decide, like, okay, where am I at personally and where is my business, and be realistic.
Yeah, and I kind of set you up for that one because I'm a financial planner, right? Planning is what we do, but any of those decisions should revolve around the business's strategic plan and your personal financial plan. And back to, we were talking about Pareto's law and a few things that are true. One of the other things that I know is true is that the life cycle of a business is not going to be even and linear every year throughout its existence. And some years are going to be easy, some years are going to be hard, but as you grow, it kind of looks like a sound wave, if you've ever seen one of those, where you might be growing and need a really substantial investment to break through some threshold to add some kind of infrastructure that allows you to get to the next level. And breaking through those thresholds is time and energy intensive, it's expensive. And in a lot of professional services, certainly in financial planning, that usually revolves around expensive hires and people that you need to bring in to grow the organization. But then once you make it and you get on the other side, you have a lot of operating leverage. Things get a lot easier really quickly until you hit whatever that next barrier is. And so if you're, the way you put it, I thought was really great. If you're 5 or 10 years away, you're just kind of running out of steam. You don't know if you want to deploy all that capital and all that energy to break through that next barrier. Probably it makes sense to think about distributing to yourself. But if you have growth trajectory and it aligns with your strategic planning, then that's when, from my perspective, you want to dump it back into the business. Did I
and I think
encapsulate that the right way? What are your thoughts?
Yeah, and I want to take the baton back on something that is there, something very tactical, that to prepare yourself to capitalize on that opportunity, and because you're right, it's almost maybe curvilinear. If I remember my microeconomics class, that it's not a straight slope
Curvilinear.
up.
That's how
Yeah,
you do it. That's the right word.
it's curvilinear, and so you might find yourself in a season that's up. It's not always going to be up. Down is not always down. It flows back and forth. And so I think this season, many of the businesses with PPP and profitability and cash flow management, just easy money everywhere, are liquid. And so I think this might be a season to prepare to capitalize on opportunity when it comes. If you're like, I'm not trying to cash, I'm 35, not 85. I'm ready to pounce, but everything's just so expensive right now. How do I prepare to pounce when there's opportunity, Robert? I would say maybe pay off or pay down anything that's variable interest debt. If you've got some leverage, if you got some fixed interest rates, keep on rocking. But if you got some variable stuff, lines of credit, asset-based lending, that's gonna start getting expensive, pay that down, pay that off. Number two, then maybe retain a little bit of working capital. The finance standard is 3 to 9%. So if that's for every $1 million of revenue, that's $30K to $90K that you just sit in a checking account. So if you're 10 times that size, you're 10 million, multiply those numbers by 10. But that's some good rule of thumbs. And so that you are then, so all the variable interest rate paid off, paid down, you've retained some working capital, 30, 90,000, right? 3 to 9% of whatever your revenue, just sitting to the side, just sitting there. You know what you are? Super attractive to the bank because you don't need their money. Oh my God. Now, instead of calling them and begging, oh, I humbly beseech thee, could you please give me money? Man, when you've paid down variable interest rate and you have some working capital, when you're ready to pounce, you'll have liquidity and you'll be in a much stronger position with your bank. Because I have found that bankers love me when I don't need them.
That's a good point. That's a really good point. And when you say that variable rate debt will become more expensive, inflation is a big thing right now. The Fed has forecast that they're going to raise short-term interest rates. That has ripple effects throughout the banking system, and all variable rates are kind of poised to rise at this point. And that's a really sound piece of advice.
Yeah. And everything I've said, we've talked about, your CPA would tell you the exact same thing. By spending money on equipment or technology, it's a capital expense. And you can accelerate when you're doing your taxes. They've told you this every year, right? The only thing you did is you bought a really heavy car that was over 6,000 pounds. That's the only thing you heard that they said. But they told you more than that. They told you, spending, training, sales, marketing, those things are all business expenses that are investments in the organization. And so I think that in concert with conversations like professionals like Grant and your CPA, you get like a little brain trust, you can make smarter, better decisions.
Yeah, I see that all the time in my practice. Everybody has usually a lawyer and an accountant. Sometimes you'll have a financial planner. Sometimes you'll have maybe an insurance professional. It's really important that that team shares the vision of whatever it is you're trying to accomplish and is communicative between each other so that whatever you're trying to accomplish, you're that much more likely to get there in the most effective way. All too often, I'm certain, this is another thing I'm certain of, that you've run into this as well. If your professional is working in a silo and not talking to anybody else, mistakes get made and you kind of fall off the beaten path pretty rapidly.
Yeah, this is probably less of an issue with your group because the person who does the corporate taxes is very often the person who does personal taxes at a small business. But at larger organizations like mine and my fellow CFOs, it's really important that, hey, your corporate CPA needs to be talking to the CPA of the owners. It is really important. Like, all of this, everyone needs to be agreeing. If there's a personal attorney, the financial advisor, the CPAs, there needs to be an annual meeting where we talk about the organization and what the plans are for the organization. 100%.
So let's parlay this into the next topic I wanted to ask you about, and that's mergers and acquisitions. So a lot of our listeners, a lot of people we work with in the financial planning firm are your smaller business owners. Sometimes they're solopreneurs. Sometimes they've got maybe no more than a couple dozen employees normally. They're starting to run out of steam. Maybe they're getting to retirement age. Maybe they're ready for a transition. They're starting to think about their own succession and their own exit. Most times we run into people, they think that their business is worth a lot more than it actually is. They've not done any planning to prepare for this transition, and they're not really sure where to start. How do you think about this, and where do you suggest people start who are approaching that kind of transition?
I think a minimum is 18 months. You need to start getting your act together before you would even approach a business broker or an industry expert. Is that you tell your inner brain trust, hey, 18 months in advance, I know I've been talking about it, but I'm really serious about selling. Because minimum 18 months it's going to take for you to get the paperwork in order and to get your financials in order. You also, so that's one pin. I want to get back to that in just a second because it's actually the most important thing I'm going to say. And then, yes, then those 18 months to finish 1 year and then to have a whole nother year, those 18 months need to be the best financial months you've ever had in revenue and in profit. And you need to use those 18 months to unwind you've been living in the business. Your kid has a cell phone, they're your assistant, they've never come in the building, your grandma's the receptionist, whatever. All that stuff needs to stop, right? Your cigarette boat that your race team needs to stop being a marketing expense. All that stuff. You got to stop it, all of it. And that's going to take about 18 months to unwind that stuff. But back to my first point is that I think a great tip is you can go online now with Google and find absolutely excellent due diligence checklists, buyer side due diligence checklists. Quick Google search. And there's 1 page, 2 page, 10 page lists of what sellers look for. What is the seller checklist? And there's dozens and dozens of these online. And that's a great tool to use. Okay, here is what I'm going to do in 18 months, I'm going to get this stuff in order, or I'm going to hire a virtual fractional resource to help me get all this stuff in order so that when I do actually approach a business broker or I actually start talking to strategic buyers, I'm already 90% of the way there in the due diligence process. And it could just be much quicker, much faster. And instead of being, what happens a lot to me is they say, hey, I want to sell in 18 days, or I've found a business broker. Then you have 90 days to get all this paperwork in order. And what happens if you do it that way, it can get done. You can certainly, in 90 days, I could sell a business, but I'd have to take everyone off their day job of running and operating and selling to work on the due diligence, and the business goes to poo, which is the worst thing that could possibly happen during a sale. So I think best practices, 18 months heads up, get the brain trust together, Google a due diligence checklist for the buy side, and go ahead and start putting all together what you'll know they're trying to find. And then, yes, please stop living in your business and get all those expenses out of your P&L.
Yeah, buyer's not going to want to pay for grandma to be the secretary and pay for your kid's cell phone. And that is the number one thing any buyer is going to do, is try to right size the income statement to strip all that stuff out to give them an accurate view of what their income and expense profile is going to look like.
Well, what
One other
happens
thing I might
is,
add too.
Oh.
No, go ahead, Robert.
Well, I was just going to say how it's presented actually is, so if somebody does all of a sudden decide they want to sell, they restate the financials. So the financials might show that they made $200,000, but the adjusted financials show that they made $2 million. And it's because they show an adjusted line and it's all the costs where they've been living in the business, right? So they actually help me find it. I've just seen some hilarious things hit the P&L of small businesses.
Such as what's the funniest thing you've come across?
Everything I just said. Everything I've said. I've seen relatives that don't live in the town. I've never seen the building. They're on the payroll. The virtual assistants. I've seen everything I've said. Just ridiculous things. No controls, and it's a little less common, but there's a certain amount of it everywhere. So it's a good thing to start trying to clean it up, right? It's like selling a house. You clean it up. Clean up your business.
One thing I want to add to this whole concept too, and we had a really good interview maybe a couple months ago with an M&A expert who's been through hundreds and hundreds of these transactions. And one of the things that she shared with us is that the whole concept of when you're ready to go to market, taking your business and shopping it around to strategic buyers can add a ton to the amount that you eventually pull out of it. And one thing that you mentioned is when you're 18 months out, you're starting to think about this seriously, get your brain trust together and communicate, hey, I'm really serious this time. I'm not joking around. 18 months, I want to sell. Don't communicate it beyond the brain trust. Because if your competitors and potential other strategic buyers are out there catching wind of this, then your leverage in a potential transaction down the road goes way down. You want to have everything totally polished up and ready to roll confidentially before you approach that business broker, because the longer that process plays out, the more likely that information is to leak, and that can really impact the market for your business.
Wow, so true. That if I was somebody in that industry, I'd be calling all your employees saying, hey, I heard Grant's selling, in 18 months. You want to come and join my team? I got a spot for you. We need a leader like you.
Exactly.
I'd be calling all your customers. Absolutely. That's so true. And I'd add something to that as a buyer of businesses, the most valuable thing to me, and I've had a couple people that had been wisely advised and they were really communicating this well, and they just won over the room and we ended up paying more than we needed to and should have. And I knew they were, but I think the number one thing as a small business, when you are talking and when you are selling, you're talking to the buyer or your investment broker is that you are the weak link. You need to sell yourself as the weak link in the organization. You're holding it back. That Julie and John and Jessica, the team that you have is amazing, is brilliant. They're running everything. You're absent. You're barely there. You're holding people back. So that, hey, Grant, if you buy Robert Incorporated, oh my gosh, you get rid of me, this business is going to explode because the team is so strong and so amazing. That's what a buyer wants to hear. The opposite is if you find out the only thing holding this together is Robert. Robert is selling. Robert has every hat. He makes every decision. If we buy this business and lose Robert, the rest of these yahoos are idiots. This whole thing is going to crash. We're screwed. I still want to buy it, but I'm going to buy it for a low multiple. This is super risky. I need a deal to make this happen. So to all you sellers out there, lose your ego. And even if it isn't true, you need to say that it's everybody else in this organization that are superstars and you're a terrible loser, and business is going to be better without you.
Yep, that's a great point. And keep those superstars around with binding employment agreements as much as you can too. transferability will help. So another topic that I wanted to ask about, the firm where you are is owned by employees through an employee stock ownership program. This is an interesting path that businesses can take when the owner is ready to exit or divest of some of their stake. It's a relatively flexible way to fund management turnover that you have a fair amount of direct experience in. And I'm curious what your perspective is on ESOPs in general. Again, the acronym is Employee Stock Ownership Program, and just the good, the bad, and the ugly. What are your thoughts, and how has it gone in your organization?
It can be great. And I think it can be a great alternative to selling, especially if the owner feels, I think one of these three kind of situations. One, the business itself has very steady cash flows. If you have wildly irregular cash flows, stop listening. You never have to read an ESOP book. It would be very bad for an organization with wildly irregular cash flows. Let's say you have regular, steady cash flows and steady, regular profitability. If culture is really important to you and you feel like you'd be losing something to sell to a strategic buyer, or maybe there is no strategic buyer and you want to continue this culture, it's a great way. It's not a management buyout. The organization itself buys you out. And it can be a great way to continue that legacy. And a third is maybe the legacy plus, you might be thinking, I kind of would like to stay along. I'd like to stay around. But I'm just tired of, as an entrepreneur, every year putting all my financial chips in the middle of the table, gambling. An entrepreneur kind of feels like that sometimes. So much of their wealth is concentrated in one thing, their business. And they're like, gosh, I'm just putting all my chips in front of the table every year, and it's getting stressful. Hey, Grant, how do I pull a little off the table and diversify my own portfolio, my financial wealth? Well, an ESOP, and you can become a partial ESOP, 10%, 20%, 49% employee owned, or you could be 100% employee owned. It can be a cool alternative as a way to de-risk, de-lever, and sell the business. That's sort of the good. The bad is, some unscrupulous business owners have, quote unquote, sold their business that just really wanted to cash out and run. And so they've given ESOPs a tarnished eye to some regulators. So over the past 20 years ago, those bad actors many years ago kind of put a tarnish out there. So the Department of Labor and the IRS gives a pretty thorough review, pretty rigorous regulation over ESOPs because of it, because of some unscrupulous actors. They pressured valuation experts to make the value of the share really high, and the business was just never able to handle the obligation, the repurchase obligation, and so they dissolved. There are a few cases of that became pretty well known. That's kind of the bad. And then the ugly, I joke, because we need a good and a bad and an ugly. The thing that comes to mind is somebody described to me, once you're managing an ESOP like I am, is that it's a pie eating contest where the prize is more pie. And what I mean by that is I work at a mature ESOP, and this gets real complicated, so I'm going to keep it simple, is that the employees who make it possible to make the revenue and the profit and the cash, they get a distribution for free, contributions for free, appreciation of share price for free. And when they leave, I pay them for the shares. And then I give those shares back away to the people left for free. So I'm here as the accountant. I'm in a pie eating contest, and everything goes perfect. I get more pie, right? I do everything I can to make the share price appreciate. So people retire, I have to pay them. They never paid me anything except for working. And then now I have to give it away. And it's, it can be an expensive thing. And so I find ESOPs, I'll give you a threshold here. I think it becomes an attractive situation when you have steady cash flows, steady profits. You have that culture that you'd like to stick around kind of thing. Maybe the culture plus you'd like to stick around. I bought a lot of businesses. The first thing I do is I fire the CFO and the CEO. I get rid of them. Boom, you're gone. That's a cost savings. And so if you sell the business, you're getting fired. With an ESOP, you get to stick around. And then the third thing is I think it is best when the businesses are a little larger. I think $50 million, $20 million is a little small in my mind for the cost of creating an ESOP. The team of advisors you need is pretty expensive. So I think 20 is when you could maybe start thinking about it. But I kind of think 20 closer to 50, it starts to really make sense financially.
Is it value of the business or amount of revenue?
Correct. Revenues. Yeah.
Yeah.
Any less than $20 million, I just think you'll find, oh gosh, the cost of maintaining this ESOP, that's pretty expensive. And the cost of establishing an ESOP and the regulatory and compliance costs, you're going to have you just have the fees. If you're less than 20 million, I think I think that would probably make it less attractive.
Yeah. And digging into this a little further, the expenses that you're talking about, you have the cost to set it up. This is an elaborate thing with a lot of regulatory scrutiny. So it's expensive getting the attorneys and professionals. It's expensive to maintain on a year-to-year basis with the help of those professionals. And logistically, if an owner is going to use an ESOP to exit, correct me where I go wrong here, because I'm sure that I will. A trust is created. Owner puts some or all of his shares into the trust. That trust borrows money from the bank to pay the owner off. And then that note is serviced through the operations of the company. The shares are then allocated to employees in some fair structure. Is that reasonably correct?
That's exactly it. Fair and free. So it's important to note that you don't pass the hat. They become capitalists. They're participants in a trust, right? The ESOT has bought the shares, and so they become trust fund babies. And they're not shareholders like making a voting, and you don't have to have completely open financials. It's not that, but you do have employee owners and an ownership culture, and you have to have a little bit more open book and more communication and more involvement by people. If you wanted to go down this route, Grant, to your point, it is its own 90-day journey of education to be able to get to a yes or no. So add 18 months, add 90 days. If you're thinking ESOP, you need 90 days of talking to 2 or 3 people. And you also have to have a tremendous relationship with your bank.
Yeah, that's a really good point. I will say, though, if you do determine that you are a good fit for an ESOP, it can provide a really nice transition. You get to stick around if you want to, and the way you framed it, of taking some of your chips off the table, you're de-risking now, but it also enables you to maybe take 2 bites out of the apple over time. You take some chips off the table, you cash out a little bit, but then if you're still in growth mode and are trying to take on other investors, you still retain some ownership if you want to. Now you have to be a pretty large business for that to work, but still, it's a viable option.
Let's say you're growing and you're like, you know what, though, I'd like to be a 20% ESOP. You're a $50 million organization. You think you're going to get to 100 over the next 5 years. And but you've been working really hard for 10 years to get to this point, and you'd like to take a little off the table just in case. You can go 20%, and then 5 years later you could go 40%, have a second bite. And then let's say 5 years from then, now you're 50 years old, and Julie's like, wow, okay, I've been running at this for 20 years now. I'd like to more be the chief relationship officer than the CEO. I've built a great thing, and it's just not worth the 80 hours a week and the $10 million of marketing and sales to get to the next level. I'm just going to I'm going to go to 5% growth. I'm just going to go more of a chill mode. You go 100% ESOP, convert to an S corporation, and then the business entity no longer pays taxes. And instead of paying federal income tax, you could pay the loan. And that can end up being a way for a business to make a big leap from a no percent ESOP or a 40% ESOP to 100% ESOP. The business, well, it has the cash because instead of paying taxes, they just pay the bank.
Right. That's nifty. I was not aware of that maneuver. But and I guess the ESOP only counts as one owner, right? Because as an S corporation, you can't have more than 100 owners. If it's 50 employees, that would be one thing, but the ESOP counts as one, I suspect, right?
I am not whoever's listening, I am not your financial advisor. I'm not licensed in the state where you live. You need to talk to someone you are paying to talk about your personal tax situation and the laws in your state to understand how a partial ESOP or 100% S corporation might work for you.
Nice hedge, my friend. You are skilled at that. I can see you've delivered that message once or twice in the past.
Yeah, I like to help people, but I also don't want to come off as like I'm an expert. And everybody's situation is different. And there could be some state or some industry that has really specific rules about who the shareholder of record is. And I am no expert in the thousands of industries out there. So I just say it's interesting and it could be cool. Talk to your brain trust.
Yeah. Well, we've got a disclaimer on all our podcast episodes too, so not to worry. So in addition to your life in the engineering firm, you run the Global CFO Council too. Tell us about that. If we have any CFOs out there listening, interested in networking with peers, tell us about that group.
Yeah, I run an educational and networking forum for senior financial executives. So if any of these business leaders have a controller or maybe they have a fractional CFO, we'd love to have them join. Just have them go to globalcfocouncil.com and get to hang out with other fellow CFOs and VPs and controllers. It's a fellowship, networking, peers helping peers, so we can all sort of learn and grow.
Very good. Important in all industries, no doubt. So before we adjourn, what have we missed, Robert? We've covered a lot of stuff on cash flow, profitability, M&A, and ESOPs. What else? What other important stuff have we missed?
I would just leave with those listening. I think that we are in a changing business environment. It's always changing, but I think dramatically so right now. Inflation and interest rates that we will see will be different than they have been in the past. And so if you've never worked in your industry during raising rate environment and rising interest, rising inflation, talk to somebody who has that older gray hair, your mentor, give her a call and ask her like, wow, what happened to this industry the last time this happened, so you can prepare. There's a lot changing. This is going to be, I think, a more risky, a more volatile year than even the COVID season from 20 and 21. 2022 is I think going to be a tremendously risky and variation. And for the CFOs that I talk to, we describe it for the larger companies. You need to stress test your assumptions. You need to do some sensitivity analysis. You need to, what if my largest customer called me and said their business will be less or business will be zero? Or what would that do to your business? How would you handle those wild changes? I think we should all do that.
Yeah. Well put. Well, thank you for sparing some time out of your week to join us. This has really been insightful to me, and I really enjoyed the conversation. So many thanks, Robert.
Thank you, Grant. I enjoyed it.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.